If you make $250,000 or more, you're probably asking a great question. What should I max out first? When your income gets this high, the question typically changes from how can I save more to how can I save more effectively? At PY Waltman Capital, we see this all the time. High earners doing a lot of things right, but still feeling unsure if their plan is optimized. While there is no one-size-fits-all solution, here's a simple savings order that can be used as a starting point in conjunction with your personal situation. For many $250,000 plus earners, the typical priority looks like this. Get the employer match, max your HSA if you're eligible, max your 401k or 403b, pre-tax and or Roth, use a backdoor Roth IRA if you're over the income limit, and then invest efficiently in taxable accounts. Now let's walk through what this practically means. So number one is going to be capture the employer match first. To quote Henry David Thoreau, all good things are wild and free. Mr. Thoreau was referencing the natural beauty of the United States here, which I cannot agree more, but as a financial planner, your employer retirement match is basically the closest thing to free money in your financial life, and therefore, a very good thing. Here's a client situation that we see often. Someone wants to invest more, but is also paying for a home, paying for kids' activities, or building cash reserves. It's completely understandable, but we still typically prioritize capturing the employer match, since it can be a highly valuable benefit. While subject to plan rules and vesting schedules, it's basically just additional compensation when those conditions are met. Step two is going to be max out your HSA. If you're eligible for an HSA or a health savings account, they can offer a powerful triple tax benefit. So contributions can reduce taxes today, your growth can be tax-free, and qualified medical withdrawals may also be tax-free. That's three. A client situation we see often. High earners overlook the HSA because it feels small. In 2026, even with a catch-up contribution, the maximum you can contribute to a family plan is just under $10,000. But when you invest it and let it grow compounding over the years, it can become a meaningful long-term tool, especially for healthcare costs later in life. Here's another situation we see. Clients don't think it's worth contributing to their HSA because they will need to withdraw the money in short order for upcoming medical expenses. Even if the account doesn't have time to grow, it's still worthwhile to contribute the money to your HSA and then use it to pay for your qualified medical expenses because you're going to get a tax deduction on the contribution. Step three is going to be to max your 401k and evaluate pre-tax versus Roth contributions. The next consideration for most high earners is to focus on maxing their 401k or 403b. But here's the big question. Should you contribute pre-tax or Roth? Pre-tax is going to lower your taxable income now, but you'll be taxed later on that when you make distributions in retirement. From a Roth 401k perspective, there's no tax break today, but those tax-free withdrawals are going to happen later during retirement. Here's often what we see at 250,000 plus earners. Many of you guys are going to lean pre-tax today because you're in a higher tax bracket. But Roth 401k can still be valuable if you want tax diversification, meaning money spread across different tax buckets so you have flexibility later. This is one area where a holistic plan matters because the right answer depends on things like your current tax bracket, future income expectations, retirement timeline, and other savings goals. Our fourth option here is if you're over the Roth IRA income limit, considering a backdoor Roth contribution. While most $250,000 plus earners can consider a Roth 401k contribution, they can't contribute directly to a Roth IRA. But you may still be able to use a unique technique called a backdoor Roth contribution. In simple terms, it's usually a non-deductible traditional IRA contribution that is then converted to Roth dollars. Important note, the pro rata rule may cause unexpected taxes if you already have a pre-tax IRA with money in it like a rollover IRA. Client situation we see often. Someone tries to backdoor Roth after reading about it online, then gets surprised at tax time. That's why we recommend coordinating with your CPA and having an advisor that sees the whole financial picture. Our last strategy here is going to be invest in taxable accounts with a tax-efficient strategy on the side. Once you've maxed the most tax-advantaged options, HSA, 401k, backdoor Roth, taxable investing is often next. This is where high earners build flexibility for goals like early retirement, real estate purchases, career changes, and building other wealth outside of retirement accounts. The key is investing in a tax-aware way because taxes can quietly reduce your returns over time. The most important takeaway from all of this is that it works best as part of a holistic plan. I might sound like a broken record here, but the truth is most high earners don't need more financial tips. they need a coordinated strategy where retirement accounts, Roth planning, and taxes and investing are all working together. That's what we focus on at PYA Waltman Capital, building a plan that's not just about maxing your accounts, but about aligning your money with your life. Want a personalized savings roadmap? If you make $250,000 plus and you want to know exactly what to prioritize and how to balance pre-tax, Roth, and taxable investing, we can help. Reach out to PYA Waltman Capital and let's build a financial plan with a high income strategy that's clear, intentional, and optimized for your goals.